been overlooked by the market. Welcome to the Valuation Master Class case study, where you'll learn all about interesting stocks and how to value them. What's interesting about Volvo is that it trades at almost a 50% discount to the market. This is Andrew Stotz of the Valuation Master Class. Let's get started. Remember, this video is for learning purposes only. This is not investment advice or a recommendation. So, Volvo is a value play with a strong dividend growth potential. Volvo is the world's second largest manufacturer of trucks with a capacity of more than 200,000 units. There's three things you need to know about this company. First, acquisition in China to ride the demand wave there, and consistent value addition through strong profitability. And the third thing is a leading role in EV, electric vehicles, and hydrogen to reclaim market share. Now, if you have any insights on Volvo or any questions as we go on, feel free to ask them in the chat. Now, let's look at some key statistics. There's 26 analysts covering the company, and its target price is a 9% upside for Swedish kroner, 240 Swedish kroners. And that's a hold recommendation based upon those analysts. So they're kind of neutral. Welcome everybody on the stream, and welcome Hillary. The PE ratio is 14 times, and the dividend yield is between 2.7 and 4.1%. There was an extra dividend paid in 2020. So our estimate is 263 Swedish kroners, and that's a 19% upside. So let's look at the price action. The price is on the way to turning bullish. Volume is signaling something unclear, but potentially going up. In the second half of 2021, the 50-day moving average has mainly stayed below the 200-day moving average. However, most recently, the 50-day moving average has started to rise, and it seems likely that it can cross that 200 moving day average. If that cross happens, it tends to be a bullish signal. So also, the RSI volume recently converged to the 50% line, which if it continues could be a positive sign. Now, also welcome to other people on the stream. I see Vian Lee. So let's talk about sales. Revenue breakdown. Trucks account for about 60% of the revenue of this company. Construction equipment about 25%. Buses 5%. And Volvo Car Financial Services are part of the others. Now you may say, well, Andrews, where's the cars? Volvo sold its car business. We'll look at that in a second. The breakdown by region is Europe 43%, North America 26%, and Asia 17%. So what's the story here? This is the key. First, the acquisition in China to ride the demand wave. You can see that new heavy-duty trucks by millions of units in China has been rising significantly, whereas in Europe and in India, it's either falling or flat. And China is by far the strongest and fastest growing heavy-duty trucks market in the world. And it's a primary market for the company to realize future growth opportunities. Instead of exporting to China, Volvo aims to ramp up sales by establishing a production site in the country. Now, this new production site is adding about 7% capacity. Volvo confirmed that it plans to acquire JMC Heavy Duty Vehicle, which owns a manufacturing site in Taiyuan, China. The acquisition accumulates to about 1.1 billion Swedish kroners. With the acquisition, Volvo aims to ramp up its sales in China. It's going to add 15,000 trucks to Volvo's capacity. And as a comparison, in 2020, Volvo delivered about 4,500 trucks to China. This is a critical story. The company is building out capacity to serve the market in China. Now, let's look at the next point, which is consistent value addition through strong profitability. My goodness, look at the comparison between the ROIC of Volvo, the red line, versus the ROIC of Daimler or Mercedes-Benz, the green line. So Volvo's impressive ROIC, return on invested capital, is attributable to its specialization in high-margin trucks and construction equipment. Volvo sold its passenger car business in 1999 as the synergies between commercial and passenger vehicles were low. Since 2021, Volvo is a separate listed entity under majority control of Geely. And Volvo's biggest competitor, Daimler, followed a similar strategy by spinning off its truck segment in January of 2022. Good to see Haresh. Nice to see you there. And all the others that are on the stream. If you've got questions, feel free. Now, let's take a look at what happens to a company's return on invested capital over time. I'm going to show you the results of some research that I did, academic style research, where I grouped companies by their return on invested capital and then looked at what happened with that over the next 10 years. And at the top of this chart, at the top left, you're going to see the number 28.2. Those were the stars. That was the average ROIC of the companies that were in the top quintile. That means the top fifth. And at the bottom, you're going to see negative 13.3. That was the average ROIC of the companies that were in the bottom quintile. When I track them on average over time, what you find is that stars fell, but they always remained above average. And dogs rose, but they always remained dogs. The thing that we want to take away from this is the concept that high ROIC companies tend to stay there. And that's part of the reason why we like it, but we like high ROIC companies. The other thing that's interesting here is that if you're investing in a high ROIC company today that's earning 25, 30, 40% ROIC, it runs the risk of starting to fall. And when it falls, earnings start to fall. And when earnings start to fall, price starts to fall. Let's continue on. Point number 3 of the story is the leading role in the electric vehicles and hydrogen to reclaim the market share. Now here we can see the company's market share, and it's been losing market shares over the past 5 years in China. That's a critical issue they have to resolve. Still, its early shift towards pure electric vehicles could help to regain its market share over the long run. The company's also betting on hydrogen, which could be more suitable for trucks due to its long distance ability. Finally, strategic partnerships with Daimler could lead to a more concentrated industry. Now, you can scan this QR code to go to the valuationmasterclass.com blog to download all full case study reports for free. Now, let's talk about the FVMR scorecard here. It measures a stock's attractiveness relative to all other companies. Attractiveness is based upon the 4 elements: fundamentals, valuation, momentum, and risk. And we look at a scale of each company relative to global peers from a scale of 1 best to 10 worst. So let's look at Volvo for a minute. And where I think the most interesting thing is valuation. So I've put a little magnifying glass on the valuation section. Let's look at it. If we look more deeply into valuation, we're going to see that Volvo is trading on PE of about 12 times and price to book of about 3 times. This is very low compared to the industry average. Let's talk about FVMR. If you're interested, some of you have already signed up. I've seen you've taken it and you're learning about FVMR. This is a $97 value course that we're offering for free right now. Just scan the QR code and learn about FVMR. And if you have any questions about it, feel free to ask there in the course. Now, let's talk about the forecast. Here you can see the consensus remains cautious, but sees some upside. In fact, they're forecasting about 9% upside. There's 17 analysts that expect the company to outperform, while 9 analysts still are cautious. Analysts expect strong revenue growth in the next 2 years, but might be too pessimistic in 2023 if Volvo can hit its targets in China. Now, given that the global truck segment is expected to grow by about 7 to 8% until 2025, I believe that Volvo can maintain a growth rate above 5%. So let's go through the P&L and just highlight some things that are here. The net profit has seen a strong rebound in 2021 and could exceed its pre-pandemic level by 2022. That's what I'm forecasting. The strong bottom line is mainly driven by the margin expansion, but also strong growth prospects. Let's look at the asset side of the balance sheet. Net assets have fallen in 2020 after selling UD truck segment to Isuzu Motors. However, increased capex for capacity expansion and battery development has led to an increase in net fixed assets again, which we can see starting in 2021, and we think it will continue in 2022. What about the liabilities of this company? Well, the company's moderately leveraged. In 2020, its net debt to equity ratio stood at about 0.9, not what I consider to be heavily leveraged. Let's look at the cash flow. Strong operating cash flow allows the company to make regular dividend payment. They skipped the payment there you see in 2020. I expect dividend yield over the near term to range between about 2.5 and 3.5. So for those people that are looking for dividend yielding companies, this is an interesting one. What about growth? Well, after the revenue rebounded in 2022, we assume revenue growth to normalize. Beyond 2022, I see a healthy annual revenue growth potential of about 5%. To be conservative, that's what we're forecasting. How about some ratios? Well, EBIT margin expansion in 2021 is likely to stay. They got all the way up to about 11.5 so far for 2021, and I'm going to forecast that's about the same. This helps Volvo to be among the most profitable truck manufacturers. Remember, in the Valuation Master Class, we learned that the average EBIT margin globally is 10%. So this is already a pretty good EBIT margin. Now, let's talk about valuation. This is the page that I've been developing to try to explain whether I think that there's long-term share price performance potential. Could this stock go up by 5 times over the next 5 years or so? Well, first we have to look at earnings. And earnings is about price and cost. If we look at revenue and cost, if we look at revenue, it's price times quantity. The potential here for upside is pretty weak because it's pretty intense competition. Quantity, well, we've seen their expansion in China. They're trying to grab that market. I think there's good upside potential. It's not like 20% revenue growth, but still pretty good revenue growth there. Cost of goods sold, the cost of the inputs for making the trucks, gross margin is already at about a 25% peak. I think it's going to be hard to expand it from there. And what about operating expenses? EBIT margin is already at about 11%. So again, that's pretty close to peak. So I don't think there's a lot of expansion in multiple potential here for the company. So what's going to drive this story is the quantity that they sell. So EPS growth solely driven by production expansion. What about price? Well, here's where it gets a little bit more interesting. The company's cheap. We've already looked at the multiples, and it's cheap relative to Swedish industrials, and it's cheap on a price to book basis. Also relative to Swedish industrials, it's almost half, both on a PE and price to book value basis. So it is pretty cheap. Now, the discount to the sector is huge, and it might move closer to average, particularly as things start to work out in China. Let's look at the free cash flow because that is such a critical component. Here we can see strong free cash flow generation is crucial for returning dividends, and they've always been positive. Even in 2020, they were massively positive during the crisis year. Now, let's look at consensus and my assumptions. Right now, expecting revenue growth of about 7.5, margins kind of come down a little bit, EBIT margin about flat, net margin strong. I mean, that's a very good net margin of 9%. You can see my assumptions related to risk-free rate and market risk premium, which get me to a beta of about a cost of equity of about 10% for the stock. And the WACC is about 7.2%. So it comes down a bit because the cost of debt is so low. I'm looking at a terminal growth rate of about 3%. So I see slightly higher revenue than consensus. Tapping further into the Chinese market would constitute a catalyst for the share price. Truck market is definitely favorable, and it has great growth prospects in China. So I'm using the free cash flow valuation method. And here you can see my base case is 263 Swedish kroners with an upside of about 19%. The bull case is about 279, and that's an upside of about 26%. And the bear case has still got some upside at about 12%. So the company, to me, looks pretty attractive. Now, we do have a question here from Tiboho says, given its low debt level, how is the company financing its huge expansion? Well, First of all, you can see it's earning a 10%, more than a 10% net margin. That means that its capacity to generate cash is huge. And I'm going to go back to answer this question by just looking at the free cash flow statement. And here, I'm just going to grab my pen here. Hold on, I can't figure out where that is. 1 second. Let me just grab my pen, and I'm going to highlight a couple of things that are interesting on the free cash flow statement that can answer this question. So the first thing that we want to look at is the most important thing is the EBIT strong in the company? So that's point number one. And if the EBIT is strong, then generally we're going to have a strong level of NOPAT. Of course, if taxes are super high, but I wouldn't worry about that. So here we can see a pretty strong and steady NOPAT. The next thing we need to look at is the amount of depreciation. And the amount of depreciation, I got to get my pen back. The amount of depreciation is pretty high at about 20. So it's almost equal to the amount of cash flow that the company's had. So if we look at, or for NOPAT, if we add back depreciation, we've got a big number of about roughly 43 billion right here of Danish kroner. So that's a pretty massive amount. Now, the CapEx is about 7. We can see right here about 7 going up to about 16, 18. But still, that's about covering. You can see here, like I taught you in the Valuation Master Class Boot Camp, that we can look at depreciation charge that's in the P&L, right? That depreciation charge is in the P&L. And we can see that the CapEx generally is the expansion in the balance sheet. That's not bullshit. That is balance sheet. Yes, there you go. So, and then if we look at the change in net working capital, it has been kind of wild here, but I would say that generally it's going to be reasonable. So the answer to the question is that the company still, after all of that, still has a lot of money left over in free cash flow. That's how they're going to finance it, with a low amount of debt. Free cash flow statement is always a great place to look, try to answer your questions. Now let's look at the world-class benchmarking scorecard. This identifies a company's competitive position relative to global peers. It uses a composite rank of profitability and growth, what we call profitable growth. It's scaled from 1 meaning best to 10 meaning worst. So let's look at this company. I'm going to benchmark Volvo against right here, 1,480 large industrial companies worldwide. Now, industrials is a very wide sector, but that's part of the point of the world-class benchmarking, is that I want to look at a pretty wide group of companies. And we can see that the company, if a company is ranked a 1 or a 2, as it was in 2019, it's world-class. Here it's come down, but it's starting to go back up in the past 12 months. Still not world-class performance again yet, but on its way. So what's going on at the growth and profitability level? We can see they're both ranked at about a 3, above average, but not yet world-class. If the company could accelerate growth, as we're expecting that they're going to be able to do, then that could drive the world-class benchmarking score back up to world-class, a 2 or a 1. And that can drive share price pretty significantly. Now, let me stop for a second. I see Louisa says, seems like they still have lots of cash reserve and room for expansion. Yeah, I think they do. And the first thing is they're trying to grab that in China. And let's see how that works. And then let's see their next move. And I think the one thing that I would say about this company is if we were talking to management, we would be asking them about their growth prospect. What is the upside to their growth prospect? Because that's the thing that's going to determine if that discount to the multiple of the industry is going to be closed. So now let's talk about the risks. Well, adverse regulatory environment in China could hamper the business, and underestimating smaller local competitors could make expansion difficult. China is not an easy market for anyone. Even for Chinese companies, it's hard. So it's hard. It's going to be hard for Volvo. And failure to keep up with technological shift to long distance electric vehicles is another potential risk. So let's wrap it up. Volvo is a value play with a strong dividend growth potential. There's 3 things to know about the company: the acquisition in China to ride the demand wave there, consistent value addition through strong profitability, and leading role in EV and hydrogen to reclaim market share. The conclusion: riding that demand wave is the biggest potential for growth, and fast adoption to EV and hydrogen give it a timing advantage in the market. An industry leading ROIC, but still trading at a discount. That looks interesting to me. So my question to you is, has Volvo's strong value creation been overlooked by the stock market? If you have any questions, feel free to ask. Otherwise, I appreciate you joining in this Valuation Masterclass case study. Remember, you can go to valuationmasterclass.com and download all the case studies that we have in our blog section. It's great to see you guys out there and everybody, and hopefully we'll see some of you guys in the Valuation Masterclass. I know I have some Valuation Masterclass students on the call, and I look forward to welcoming you to the next Valuation Masterclass. This is Andrew Stotz saying, thanks for joining.